Hey everyone, welcome. I'm so glad you're joining us for today's explainer. We're getting right into one of the biggest, most fundamental choices you're going to face as an investor. Whether you're literally just opening your very first brokerage account today, or you've been building up a portfolio for years, you've probably hit this exact crossroads. We are going to entirely demystify the structural differences between exchange-traded funds, which we all call ETFs, and traditional mutual funds. Now look, there is a ton of debate out there about which one is quote-unquote best, but we aren't taking sides here. No way. Instead, we're going to look strictly at the actual mechanics behind these two financial vehicles, pulling from solid data and research from heavy hitters like Fidelity, Charles Schwab, T. Rowe Price, and the SEC. By the time we're done, you'll understand exactly how they're built, so you can decide which one actually fits your specific financial goals.
Here is our roadmap for the explainer so you know exactly where we're headed. We're going to cover 1. Investment baskets. 2. Trading flexibility. 3. Management styles. 4. Costs and fees. 5. Tax efficiency. And finally, 6. Choosing your path. Let's get right to it.
Section 1. Understanding investment baskets. Two paths to the same destination. Okay, let's dive into this by laying down the foundation of what these financial vehicles actually are. I want you to think of ETFs and mutual funds kind of like a fork in the road. They are two totally distinct paths, but they ultimately aim for the exact same destination.
So what is the difference? This is the fundamental question that trips up so many beginner investors. You hear these acronyms thrown around constantly on financial news networks, right? But when you strip away all that confusing jargon, what is the actual structural difference between the two? Well, before we look at how they're different, we really have to understand their biggest similarity. Both ETFs and mutual funds are what we in the industry call a basket of securities. The SEC defines this as pooling money from a bunch of different investors to buy a diversified collection of assets. Things like stocks, bonds, or a mix of both. Instead of you going out and buying one single share of one company and taking on all that concentrated, scary risk, you just buy into the basket. This shared goal of professional management and broader diversification, that's the baseline for both of these vehicles.
Section 2. Trading flexibility and liquidity. How and when you trade matters. So while they both hold a basket of assets, the way you actually go about buying and selling those baskets is where our two paths first diverge. Let's look at how this works in practice. On one side, we've got ETFs. Just like the name implies, exchange-traded funds trade directly on a stock exchange, literally just like an individual stock. You can buy or sell them intraday, meaning continuously throughout the trading day. You can even use advanced tactics like limit orders or short selling if that's your thing. And the price, it fluctuates second by second. Mutual funds, on the other hand, are totally different animals. You don't buy them from other investors on a live exchange. You actually transact directly with the investment company itself. Orders are executed only once per day, right after the market closes. Anyone who invests on that same day gets the exact same, uniform price. Plus, ETFs can often be bought for the price of a single or even fractional share. Mutual funds, they frequently require a set minimum initial investment, sometimes $500 or even way more.
So the crucial point here is really understanding how that once-a-day pricing for mutual funds actually works. It all comes down to something called the net asset value, or NAV. Because mutual funds aren't actively trading back and forth on an exchange during the day, the fund managers basically just wait for the closing bell at 4 p.m. Eastern Time. Then they tally up the closing prices of all the assets inside their basket, subtract any of the fund's liabilities, and divide that by the number of outstanding shares. Boom, that NAV becomes the official price for anyone buying or selling the fund that day. Drawing on some great data from T. Rowe Price, we can brilliantly summarize these structural rules. Think about it like this. If you really value continuous liquidity, being able to buy fractional shares, and knowing exactly what price you're getting the absolute second you click buy, then the ETF approach is tailor-made for you. But if you prefer the simplicity of just placing an order, stepping away, and letting the end-of-the-day NAV dictate the price, totally avoiding all that chaotic intraday volatility, well, the mutual fund represents that much more structured approach. Section 3. Active versus passive management. Who is steering the ship? Now that we know how these baskets are bought and sold on the outside, we need to shift our focus to the inside. Historically, and honestly still predominantly today, mutual funds are actively managed. This means there's an actual professional portfolio manager backed by a whole team of really smart research analysts actively buying and selling the individual securities inside that basket. Their goal isn't just to match the market, they want to beat it.
If they're measuring their performance against, say, the S&P 500, they are actively trying to deliver higher returns than that benchmark. And in a really rough economic climate, these active managers can also play defense for you. They can sell off risky assets and move cash into safer, conservative investments to try and protect the fund's overall value. And this brilliantly illustrates the completely contrasting philosophy of passive management, which is really the primary domain of ETFs. Most ETFs are designed to passively track an index rather than trying to beat it with all that active stock picking. As Charles Schwab notes in their research, passive funds just replicate the market faithfully. If the index drops, the ETF drops. If it rises, the ETF rises. It's a slow and steady tortoise strategy that requires way less day-to-day intervention from a manager. Section 4, comparing costs and hidden fees. What you see and what you don't. Because active management requires highly paid analysts and a ton of continuous trading, it brings us directly to the cost. And listen, when you're investing over decades, seemingly tiny percentage fees can massively erode your long-term compound returns. Fidelity points out that mutual funds generally have a much more complex fee structure than ETFs. There are two specific terms you absolutely need to watch out for: sales loads and 12b-1 fees. A sales load is essentially just a commission paid to the broker who sold you the fund, and that can often range from 1 to 2% of your investment, taken right off the top. A 12b-1 fee is an annual marketing and distribution fee that's actually embedded right in the fund's operating expenses. This means mutual fund investors are often indirectly paying for the fund's advertising out of their own returns. So yes, you might literally be paying for those fancy mutual fund commercials you see on TV. When we put the two side by side, we see a totally different philosophy and how costs are handled. In a mutual fund, structural expenses are basically shared. Because everyone buys in at that end of day NAV, the costs of running the fund, paying the managers, the marketing, the back office operations, they're all pooled together and deducted from the fund's total assets. ETFs, on the other hand, generally don't carry sales loads or those marketing fees because they're mostly passive. However, ETF investors directly bear their own individual transaction costs on the open exchange. That usually means standard brokerage commissions and something else that's very specific to ETFs. That specific cost is called the bid-ask spread. Because ETFs trade like stocks, there's always a tiny little gap between what a buyer is willing to pay, the bid, and what a seller is demanding, the ask. If you're trading a massive, highly popular ETF, this spread is usually just pennies. You'll barely even notice it. But if you trade a really niche, low-volume ETF, that spread widens out, and it acts as a hidden transaction cost every single time you buy or sell. Mutual funds, because you transact directly at the NAV, completely avoid the bid-ask spread altogether. Section 5, Understanding Tax Efficiency, the hidden drag on returns. Everything we've talked about so far builds into one of the most absolutely critical, yet honestly least understood differences between the two. How the internal plumbing of these funds operates can have massive tax implications for you, even if you personally haven't sold a single share. Let's walk through the life cycle of a mutual fund redemption. Imagine a massive group of shareholders suddenly decides, hey, we want to cash out of this mutual fund. To pay them all their cash, the mutual fund manager is quite literally forced to sell off underlying stocks or bonds from the portfolio. If those securities have gone up in value, selling them realizes a capital gain. Now here is the kicker. The IRS requires mutual funds to pass those capital gains taxes onto all the remaining shareholders at the end of the year. So you could just be sitting there holding your mutual fund shares peacefully, doing nothing, and suddenly get hit with a tax bill just because other people decided to sell. Now, what's really interesting here is how ETFs uniquely solve this exact problem. ETFs utilize a brilliant structural loophole called the in-kind creation and redemption mechanism. When big institutions want to pull their money out of an ETF, the ETF manager doesn't actually sell stocks to give them cash. Instead, they just hand over a basket of the actual underlying stocks, an in-kind trade. Because no cash changes hands and no stocks were technically sold on the open market by the fund manager, it simply doesn't trigger a taxable capital gain for the everyday investors who are still holding the ETF. This makes ETFs incredibly tax efficient in a standard taxable brokerage account compared to a typical mutual fund. Section 6, Choosing your investment vehicle. Aligning structure with strategy. We have covered a lot of ground today, right? From intraday trading to NAV, from active managers to hidden 12b-1 fees and structural tax efficiency. It is time to bring it all together. Let's look at how you can align these unique structural traits directly with your own personal investment strategy. Based on all the research we've unpacked, you might consider leaning toward an ETF structure if your strategy really demands flexibility.
If you want the ability to trade intraday, use stop-loss orders, or buy fractional shares instantly, the ETF is literally built for that. Furthermore, if you're investing in a normal taxable brokerage account, rather than a tax-sheltered IRA or 401k, the ETF's in-kind tax efficiency is a major, major advantage. Finally, if you believe in that slow and steady tortoise approach of passively tracking a specific index with minimal expense ratios, an ETF is generally going to be your go-to vehicle.
Conversely, a mutual fund structure absolutely shines in different scenarios. If your goal is to actively try to beat the market benchmark, you're generally going to seek out an actively managed mutual fund backed by top-tier analysts. This is especially true, as Charles Schwab points out, in less efficient markets, like emerging global stocks or high-yield bonds, where a highly skilled manager can actually uncover hidden value. Additionally, if you prefer a highly structured set-it-and-forget-it approach where you simply invest your dollars at the end-of-day NAV, completely avoiding the anxiety of bid-ask spreads and intraday price swings, a mutual fund provides exactly that peace of mind.
Ultimately, neither path is universally superior. They are simply different tools engineered for different jobs. Whether you value the fluid, tax-efficient, low-cost indexing of an ETF or the structured, actively managed, straightforward daily pricing of a mutual fund, the choice depends entirely on you. So I want to leave you with this question to really reflect on. Based on your personal financial goals, your tax situation, and your trading style, which structural path best aligns with your investment journey? Thank you so much for joining me on this explainer. Keep learning, keep structuring your strategies, and I'll see you next time.